Hello everyone and welcome back to the channel, Finance with Ian. My name is Ian and today we'll be talking if dollar cost averaging is the best long-term investing technique. I know when it comes to long-term investing, you don't want to spend too much time researching and you don't want to spend too much time looking at charts. That is kind of the point of long-term investing. Something that will make you money that won't take up too much time. So in this video, we'll be discussing if there's a better alternative to dollar cost averaging. So before this video begins, make sure to scroll down a bit and drop a like to push this video to a larger audience. Subscribe to stay tuned for more financial videos in the future. And let's get into this video. So, we're discussing what is the best technique when long-term investing. First off, we need to define what long-term investing is. A long-term investment account differs differently from a short-term investing account, because in the short-term investing account, you're more likely to sell stocks quicker, whereas long-term investments will not be sold for years, and sometimes they'll never be sold. Now, in the cases where it's not sold, it could be because it's more profitable to live off the dividends, but we won't go into too much detail about that. Being a long-term investor means you're willing to accept a certain amount of risk in pursuit of long-term rewards. It also means you'll have to wait a while for your returns to come back to you. To be a long-term investor also means you have to have enough capital that can be tied up in an investment that you don't need at the current time. So basically, long-term investing is like diamond handing as much as possible, no matter what happens, for at least 10 to 15 years. For all the viewers that don't know what diamond handing is, it just basically means holding on to a stock no matter what happens, even if the stock crashes. The Wall Street Bet viewers know exactly what I'm talking about. Okay, now that we know what long-term investing is, what technique is the best to use when long-term investing? Which one exposes us to the least risk? Which one will give us the most profitability? Well, probably the most common one is dollar cost averaging. What is dollar cost averaging? So dollar cost averaging, also known as DCA, is an investment strategy where the investor takes the total amount of time he'll be investing and divides it up. And every time he crosses a period, he'll make a payment. So essentially, you're making periodic purchases throughout time. This reduces the overall volatility when you first buy into the market. An example of dollar cost averaging working out well is if you look at the Apple stock. If you were to bulk buy Apple late January, you would actually be down right now, even though it would have been 3 months since that initial purchase. So basically, dollar cost averaging is to avoid this volatility. In effect, this strategy helps you remove all that effort of trying to time the markets perfectly so you can buy equities when they're at a good price. Dollar cost averaging is also known as the constant dollar plan. Dollar cost averaging is probably the most popular technique when businesses offer 401ks. So in other words, dollar cost averaging is adding funds to account, which whoever controls the account then immediately buys into the market. So the pros to dollar cost averaging is that volatility will not really affect you as long as you have your money in there from at least 10 to 15 years. Not only that, but if you're buying the stocks and ETFs that pay dividends, over time, you can use those dividends to reinvest back into the market. That little bit of buying power over time will add up and help you add more shares to your portfolio. There are a few cons, but there's only about one worth mentioning, and that is if the price of the underlying stock does not rise over time. The reason why I say this isn't a huge worry is because you probably aren't going to invest in a stock that has a risk of crashing within the next few years. Instead, you're more likely to invest in an ETF or an index fund, or something that tracks a large number of companies over a period of time. The reason why this works is because the overall market of the United States is a strong one, and the overall growth of companies here is pretty positive. So the ETFs and index funds, which are the baskets holding all those companies, will likely rise as well. So when you're constantly buying in, the price you buy in is most likely going to be lower than the price of the stock 2 years from now. This means that you'll always be in the green in your investments, and those stocks you started buying long ago will profit you the most. So, is dollar cost averaging really the best way to invest long term? Well, a study conducted by a group of teens in college found that a different technique called value investing is actually better. What is value investing? Well, this is how Investopedia explains it. One strategy that has started to gain favor is value averaging, which aims to invest more when the share price falls and less when the share price rises. Value averaging is conducted by calculating predetermined amounts for the total value of the investment in future periods, then by making an investment to match these amounts at a future period. So basically, value averaging is buying the dip, especially in strong sectors that will most likely recover in the future. It seems simple enough, and the good part is, although it seems like it may take a little bit more work because you'll have to watch the charts on your screen to see which one falls, the technology and software of our current day will send us alerts if a stock falls 5% or more. So this way, instead of having to watch charts, we can just set alerts and do nothing. Wait until the dip happens. So let us compare these two techniques to see which one is better. So this study that I mentioned earlier was done on the S&P 500 from 2011 to 2020, which the New York Stock Exchange said was one of the strongest bull runs of history. Please note that the percentages I mentioned here do not account for inflation, so you do have to count 2 to 3% each year for inflation. So using the dollar cost averaging technique, it was found the average return annually each year was 11.6%, which is pretty strong. However, once they tested the value averaging technique, it was found that the rate of return was 12.6%. That's an entire 1% difference, and that's pretty magnificent when it comes to an annual rate. So although it looks like value averaging is the best investing technique, there are a couple of problems that come along with it. First is having to watch stocks continuously. We already mentioned earlier that you can always have alerts sent to you if the stock market falls. The second, and this is somewhat the bigger problem, is that everyone has limited buying power. And for example, say you're using the value averaging the past couple of months when we've seen a short bear market. Many sectors dipped multiple times over the past few months, and you would have most likely ran out of money before it hit the quote-unquote bottom. So while both of these are small problems, they can quickly be overcome by having alerts sent out to you and having enough money on the sidelines just in case you want to buy in on a crash. You guys already know the saying, buy the dip.
Here we go, come on, push it, buy the dip, buy the dip. Here we go, come on, push it, buy the dip, buy the dip.
So the truth is, if you want to be a great long-term investor, you have to keep buying into the market. So although that value averaging is better overall, if you have a mix of all the long-term investing techniques, you'll most likely be fine. As long as you stay consistent buying into the market, never sell your stocks, and keep those diamond hands, you'll be fine heading into retirement. With all that said, thanks so much for watching the video. Make sure to scroll down a bit and drop a like to push this video to a larger audience. Please consider subscribing since it greatly helps out my channel. Not only that, it'll keep you in tune for more financial videos in the future, and I'll see you guys later. Thanks for watching.